Welcome to the October property market update, and the bubble has burst. It's finally burst and the property market's going to crash. Well, it is if you listen to articles like this that has come out. What a month it has been, by the way. So the Express put in an article, UK price crash, home owners warn values could plummet by up to, wait for it, 40% in a huge blow. There's more articles as well. CNBC, mortgage mayhem sparks fear of housing market crash in Britain. These articles are coming in thick and thin, and The Guardian reports UK house prices may fall 20%, aimed mortgage carnage, warns experts. So look, this is the October property market update, and what we're going to discuss in this update is what's gone on over the last month and what a month it has been. As I said, we're also going to discuss what we can be doing as property investors to be navigating this. So make sure you stay around to the end, because I'm going to give you two major things and the major opportunity in this market. Whenever there's change, there's massive amounts of opportunity. And what Warren Buffett says is observe the masses and do the opposite. So when everybody's really worried about things, this is where the opportunity is. But the opportunity is only for those that navigate this correctly. So make sure you stay to the end, because I'll be giving you some really practical, useful things you can be doing in this market right now. But the most useful thing you can do right this minute is hit that like button. Helps the algorithms and helps my ego. But with that said, let's get into this month and let's discuss the big four. The big main four players that we get is Nationwide, Halifax, Rightmove and Zoopla. That's where you want to gather your information from. And all of them gather information slightly different, but that's the four places where we're going to get price indication and price indexes the best. So we're going to go over all of their reports from the last few months, and then we're going to come to some sort of understanding of what we can be doing and how we can be navigating this crazy market. But why is the market so crazy? Why have we had such a big shift? The thing is, I always say this, Warren Buffett says this all the time, he never makes an investing decision based on what he thinks the market's going to do. So always make your property investing decision based on solid fundamentals. We cannot time markets. If you asked me 2 months ago if I felt the market was going to crash, I'd have said maybe it'll slow down a little bit. You ask me now with what's gone on over the last month, I'm thinking the odds are definitely increasing. And the reason it's changed, in my opinion, the thing is, I don't know, it's just my opinion, by the way, but the reason my opinion has changed in such a short period of time is because we can never indicate, we can never tell what policymakers are going to do, what government's going to do, what's going to happen when people come in power. So one of the major wobbles we've had over the last month has been the new government and their new budget. Liz Truss has waltzed into number 10 Downing Street, and she has caused mayhem. I'm not going to go too much in depth on this video, because I want to discuss more around the prices and what to do, but I have done a video here about the budget. But this has caused massive repercussions and rumbles without the whole economy in the UK. Inflation was already running out of control anyway, and this is potentially putting a bigger pressure on inflation, because what she's doing at the moment, she's done loads of tax cuts. As I said, watch the video to see the full in depth, but she's done loads of tax cuts, which is going to be more fiscal stimulus into the market. One of the main reasons we've got high inflation is because there's been so much money printing, and she wants to print a ton more money to put into the market. So again, I've done a video on inflation here, so you can watch that more in depth. As I said, I really want to focus around the house prices and what to do, but it is important to discuss some of the reasons why the last month's been so crazy. And one of the crazy things that happened is the pound collapsed. And again, this was a direct result of this mini budget. So the pound hits all-time lows, bounced back a little bit, but again, this has massive impacts on us as a country. Inflation's already high. It's going to push inflation higher because importing gas and oil is paid in dollars, and we're weak against the dollar as a pound at the moment. And it's released shockwaves across the whole economic landscape for the UK, and our credit rating was just dropped down to where Greece and Italy was at the moment. But let's dive into the house prices. The house prices will give us an indication of where things are going. Is it 40% drop yet as expressed, or is that just headlines? I'll tell you at the end what my views are around this. But yeah, let's look into what the big four are saying. So let's start with Halifax. Halifax is the largest mortgage lender in the UK, so they're positioned well to be able to tell you what people are paying and what's going on in the mortgage market and the property market. But what you got to remember, property has a lag because it takes so long to go through legals. It used to be around 2 to 3 months. It's more like 4 to 6 months to get a deal through legal. So there's a big lag time in property in compared to stock markets, cryptos and other asset classes. But look, in October, Halifax has reported prices are down 3 months running, and annual house price inflation tumbles to 9.9%, down from 12.5% at its high in June. Prices down 0.1% month on month. Average property price has hit £293,835. And it goes on to say house prices in the UK are likely to fall by at least 10% next year as mortgages providers pull deals and raise interest rates payments to levels not seen since before the 2008 financial crash. Property experts have predicted that this is going to have an impact of 10%. And they also go on to say annual house price growth fell in September for the 3rd month running consecutively. So look, this is definitely starting to show signs. This sign has showed quicker the last month than it's shown in any other month, because we've been heading towards this. So it's no big sort of conspiracy or big secret that we're heading towards some sort of economic headwind. We've been talking about recession for a while, and it's no big secret because they've been printing lots of money. You print that amount of money and dump into the economy, it's going to have repercussions. But let's have a look. Look, the charts show us a little bit more. If we look on this Halifax chart here, you can just see how it's been steadily climbing up, plowed a little bit, climbed again, and now we're on a bit of a decline over the next 3 months, over the last 3 months, should I say. Let's look what these prices look like. So looking at this chart again, well, not this chart, but this spreadsheet from the Halifax, it shows you, look, September 2021, the average house price was 267,000, sorry. And as we fast forward, we can see it hit its peak around June time at 293,586, and then it dipped in July to 293,173. So not a major dip, but then it dipped again in August to 293,992. No, sorry, it jumped a little bit in August. Then it's dipped again in 293,835. So we've had dip, increase, dip. So it's going to be an interesting time. But as I said, it does have a major lag on, do have a major lag, should I say, on prices because of it takes so long through legals. But let's have a look what Rightmove's saying. Biggest platform out there that sells properties. Difference between Rightmove and Halifax is Rightmove's data is based on asking prices, not sold prices. But this is what Rightmove had to say. Prices rise typically for price rises typical for September while demand is up. So it's taking a different stance on this. The average price of property coming to the market increased by 0.7% in September, £2,587 to £367,760. The rise is in line with the 0.6% average asking price increase among new sellers for September over the last 10 years, according to Rightmove. On an annual basis, asking prices are 8.7% higher this month than they was a year ago. So it shows you the asking prices are not quite catching up with what the actual sold data is. But if we have a look at this trend on the asking prices again on this chart here on the trends, you see it's going up, dipped a little bit, then went up again. But an interesting thing is what the prices are per region. This is the asking price again, but per region you can see there is 3 regions down at the moment. We've got West Midlands, East Midlands and Wales. The rest of the regions are all up on their asking prices. But as I said, asking prices are not sale price. What somebody asks for something and what they achieve for it are very, very, very 2 different things. So it's good to get a blend between the 2. It tells you where the agents are pricing things, where people's expectations are, but it tells you where the reality is or what they're achieving for stuff. So now let's move into nationwide, another big house index in the UK. And again, this is based on sold data, not on asking prices. And the Nationwide jumped in and said, house price inflation slows to single figures, according to Nationwide. Annual house price growth dips to 9.9% in September. Monthly growth stats as new buyers inquire decline. Typical UK home now costs $272,259, and they are slightly different. If you go on the Nationwide website, it shows you why their statistics are different from Halifax's. I'm not going to talk about that here, but I'll give you a link in below if you want to actually read why they are slightly different. But obviously, they're different mortgage providers. But you want to grab this all this data, put it into one big mixing pot, and then come out with your own sort of conclusions. But an interesting thing, Nationwide own TMW, which is the mortgage work, which is one of the biggest lenders. It may even be the biggest lender, but definitely one of the biggest mortgage property buy-to-let lenders in the UK. And this article come out from them saying TMW relaunched buy-to-let products. So on Friday the 30th of September, the Mortgage Works will reintroduce its range of fixed buy-to-let mortgages following their temporary withdrawal on Wednesday the 28th. So they withdrew from the market for 2 days. A lot of people withdrew, a lot of mortgage lenders withdrew their products, not just because of what's got the uncertainty, it was partly because of that, but also because they got an influx of applications, what they couldn't handle because everybody was trying to fix their mortgage thinking that there's loads of talks of the rates are going to go to 7%, 8%, 10%. Rates are definitely on the up. Well, I'm getting some offers. All the offers I'm getting in at the moment for rates around 5%. We even had one about 6%. I even had a crazy one because it was a difficult thing to lend on. There's only a few lenders. It was around 8%, which is absolutely bonkers. But there still is quite a few products out there around in the 4s, touching the 5, which on the long-term average is pretty good. What we've got to realize is at 0.01% or 0.25% interest base rates for the bank is artificially low, and we've never had rates that low for that long. So we've just been led into a bit of a lull, a false sense of security, lulled into a false sense of security. That's how I was trying to say it, because that was an unrealistic rate what I've had over the last sort of decade anyway. I remember when I first started investing, I was paying the same rates I'm paying now and 30% deposits, and that's back in 09 when we were right in the middle of the 08 crash. Let's see now what Zoopla says. Again, Zoopla is based on asking price, not so much on sold prices, but the portal says the typical UK home now costs $258,000 compared to $256,000 in July. So a little bit of a lag on that data there. Some of them are really up-to-date data, some of them have got a bit more of a lag. Zoopla warn also that rates will affect affordability for people. They also go on to say, are we shifting to a buyer's market as prices potentially reduce? So we're being in a seller's market for the last 2.5 years means it's more easy to sell your home, makes it much more difficult for us investors to buy bargains and good deal properties because it was a seller's. Well, now they're saying, are we moving into it? And I'm 100% agreeing, because Zoopla also go on to say stock levels are also increasing, giving buyers bigger choices of homes, biggest choices of homes since May 2021. So let's share my views and kind of predictions. They're loose predictions. Nobody knows what's going to happen because none of us know what's going to happen on the outside world. So we can look at all the data today, but then Liz Truss could be kicked out by the Conservatives and totally change it. We could have the war escalate to nuclear war in Europe, totally change things. We could have a war between Taiwan, China, and America, totally change things again. We do not know what the policymakers are going to do. We do not know what the outside force is going to happen. We do not know we get natural disasters like we did with COVID. We cannot predict these things. So what we need to be doing is making solid fundamental investment decisions based on the investment, not based on what we think the market's going to do. But with that said, we still have to look at what's happening in the markets and try to make some judgment on what's going forward. So what I'm going to share you now is just my judgment. I don't know if this will be true, but at the moment with the information we got standing with us right this minute is I predict that it's going to the market will dip a bit more. I think there's going to be macro and micro economics going on. So I think some areas where the price per earnings ratio is really, really wide is going to be affected a bit more. The areas where the price per earnings ratio is a bit more in line, it's not going to be affected as much. So what I mean by price per earnings ratio is the price of the average earnings in the area compared to the average property price. I think the overinflated ones and that little band of people that stretch themselves in the middle class and these properties are going to really start feeling the pinch with the energy cost increases, the mortgage increases, the just the cost of living in general increases. But what I predict as well, this will create a massive buyer's market. So massive amount of opportunity. There's tons of money out there. Because the pound's so low, there's loads of overseas money coming in. We're a sourcing company. Just yesterday, we're negotiating 2 more deals. We're actively buying. Just over a week ago, we negotiated another deal, and they still work fantastically. Because what I'm suggesting you do is, if you can trade and make money, what's going to be difficult is the valuations in this market. So you're going to get down valuation because the bank's going to be cautious. So the BRR model is going to be more difficult. It's going to be achievable, but more difficult. Bank's going to want you to have a bit of skin in the game. But what the opportunity is going to be is there is going to be people who want to park their money into property because it is a safe haven. And the banks are still lending. Banks have still got products out there. They temporarily stop them. So deal packaging and deal source. I've been a deal sourcer since 2015 and the source probably coming up to about 80, 90. I've not even counted deals. We've got about 18 or 19 in legals at the moment, and some of them being done right now because already I'm getting sent more and more deals, and I've been sent more deals in the last week than I've been sent in the last probably 2 months, because it is becoming more of a buyer's market, which is a fantastic place to be. Obviously, you need to fund these deals, so either getting JV partners or raising capital. Be careful about lending money because you've got to pay it back, and you might not be able to refinance. You might have to sit on it a bit longer, but it is going to be a massive opportunity and people will want to buy deals. We are still selling deals as deal sourcers. So if you're not a deal sourcer already, think about being a deal sourcer, at least a side hustle deal sourcer. If you want to learn more about being a side hustle deal sourcer, join me on my workshop next Sunday, not this Sunday, tomorrow, Sunday afterwards. Join me on my next workshop and I will teach you how to be a side hustle deal sourcer. You don't have to have all the pain of being on social media, posting all the time, where if you want to build a portfolio for yourself, which I believe you still should be building portfolios, strong, solid, vanilla single lets is the right stuff to buy if you're early in your journey. There is opportunity in the bigger stuff, but you've got to make sure you can protect the downside in case you get caught on bridging or you can't exit it. But if you're not in that position, single let properties and build an all-weather portfolio like what I suggested in this video here is the place where you're going to be to really navigate this. And you've got to be able to raise capital or earn capital. If you do that by trading deals, you're in the same market, you're getting social proof, and then you're adding it to your own deposits. And if you invest remote like I do, deposits can be as little as 12, 15, 20K, which if you source, the average deal I've sourced over the years has been about 5.5K. So if you source a few of those, you're getting social proof, you're getting experience, and what you're also getting is money to put towards your deposits. You don't have to worry about where that's at the moment. And if you ride this little period out, it's going to be massive opportunity. There's massive wealth transfers and shifts in these times. And look, you can either be part of it or you can sit on the fence and just watch it play in front of you. The reality is if you leave money in the bank, if you've got money in the bank at the moment and you leave it in the bank, you're losing around 10% every year. So if you've got 30K in the bank or you've got 20K in the bank, which is enough to do a deal in my remote location, you will be losing around 4K per year. You could put that in a property and earn 3K per year. What would you rather do? Lose 4K or earn 3K? So as I said, if you want to learn how to be a side hustle deal sourcer, how to find deals, how to package them on, how to build a portfolio that's solid, that's going to last you through these tough times, join me on my workshop, next up and coming workshop. Link's going to be in the bio. Link for it is bit.ly/invest remotely. Listen, there's a massive opportunity here. You can sit on your hands and watch it. You've got to be cautious. You've got to do this correctly. That's why you've got to educate yourself. So join me on the workshop to educate yourself. Listen, if you're still here right now, massive thank you very much. We're in massively interesting times, but remember, if you don't evolve your ideas, you're never going to live on your own terms. So make sure you smash that like button if you didn't do it at the start. Hit the bell, subscribe button, hit the bell icon if you've not already done that so it notifies you when we do videos, and evolve your ideas to live on your own terms and have a fantastic day.